Holistiplan presents Tax Time with Jeff Levine. Let's talk taxes. Hello, I'm Roger from Holistiplan. I'm sitting here with Jeff Levine. He is the Chief Planning Officer at Buckingham Strategic Wealth. He's also a member of our team here at Holistiplan as our tax planning strategist. Jeff, how are you doing?
I'm good, man. Yourself?
Doing great. Unlike the markets this year, I suppose. And by
What?
by markets, I mean like all the markets, I think. Fortunately, I'm not in a position where I have to really watch these things like I used to, but from what I can tell, as of our recording, S&P 500 down about 15% this year. Does that sound about right?
Yeah, sounds about right. Yeah.
10-year Treasury down about 20%. Something like that.
The 10-year Treasury is down 20%. Really?
I think, yeah, I checked that just before the call. And then depending which cryptocurrency you're in, also down.
A lot.
Things are down. Things are down.
Yeah. Corporate bonds are down too. I mean, U.S. ag is down quite a bit. So it's yes, yeah. There's not much place to hide, I guess, maybe except for real estate.
Well, those just priced differently, not as often. Yeah.
Fair.
Yeah, maybe you're right. So we're going to talk about tax planning strategies in down markets. And we've identified 3 areas where advisors could be making some tax related moves in response to these down markets. All 3 kind of making moves under the assumption that markets will come back, and eventually they should. We just don't know when. So
history would tell us that will happen at some point.
At some point in our lives, if we eat healthy, it'll happen. So the first one we identified is probably the most obvious, which is just loss harvesting, capital loss harvesting, realize those losses. Presumably pretty straightforward, although we do have to watch for things like wash sales. Any comments on loss harvesting, how we approach that?
Well, yeah, a few things. First off, there's inherent value there in that there is $3,000 of potential arbitrage here, right? Where you can take perhaps like a long-term capital loss that you might only be able to offset, capital gains for, and turn it into a loss against ordinary income. And if you're in a high tax bracket, I mean, even the 24% tax bracket, that's almost $750 of tax savings there if you can run a $3,000 loss for the year. Now, again, it's always better to make money than lose money, but if you've lost it, at least temporarily on paper, sell, right? And you can capture those losses. It's also worth like banking some of those losses potentially for future years, right? Effectively, what you're doing is kind of buying tax deferral on your taxable assets by capturing those losses today, because when you sell down the road, even if you have capital gains that exceed your losses in that year, if you've got some carry forward capital losses, you can use it to eat it up, and you're effectively pushing out that tax liability into the future. And of course, for those who are older, closer to end of life, that's even more powerful, because now we're getting closer to the potential step up in basis. But even for younger individuals, the idea of tax loss harvesting is effectively, a tax deferral play at the heart for a taxable account. You talked about the wash sale. That's absolutely worth touching on here. Simply put, if you own a stock or any other sort of security, you cannot sell it and then buy back within 30 days, either before or after your sale at a loss, the same or a substantially similar position, and take the loss. If you do that, instead of getting to take the loss now, you have to kind of add the loss to your basis in the new position, and it doesn't give you the same benefit from a tax loss harvesting perspective. But Roger, you did bring up crypto, and I would be remiss if I didn't point out here that because of the way cryptocurrency is currently treated as property and not as a security, well, in that particular case, it means that the crypto transactions are not subject to the wash sale rule, nor, by the way, are things like commodities, et cetera, right? They're not subject to the wash sale rule. So you might be able to sell your position in the morning at a loss and buy it back in the afternoon so that you remain invested, so that if there is a recovery, you are participating in it still.
Jeff, you said substantially similar security. So let's say I want to stay fully
Essentially
invested.
identical, I guess. Yeah, whatever you want to call it. But yep.
So I'm in an S&P, there's multiple S&P 500 ETFs, for example. Let's say I own one of those, or some ETF of some basket, some index or some basket of stocks.
Yep.
I can sell that one. And what if there's another S&P 500 ETF out there?
Yeah, so this is one of those questions that comes up all the time, like what actually, is substantially, identical. And it's a lot of judgment. We don't have a ton of guidance in this area from the IRS. I certainly would not buy the same index from a different provider. You might say, well, it's, this one is Vanguard and this one Schwab. If it's a S&P 500 index, it's pretty similar. Now, at least to me, right? I could make the argument that if you had a factor tilt on something, that maybe if you have a different factor, that might work, or going from a mutual fund to, a S&P 500 fund to an S&P 500 index, that might be, not considered substantially identical. But I would give it a little bit more space than just switching between providers of the same exact index. It's pretty darn similar.
Yeah. Okay. Got it. Yeah, that's like me as a teenager. That's like a little too smart alecky for its own good, right? So yeah, not just as a teenager, now as well.
Well, I like the fact that you're thinking about creative solutions to problems. As
there we go.
Yeah, as the person who's coding in the software here on the tax side, that is very valuable for us.
Well, we used to trade individual bonds in my old firm as a way of actually saving some of the, you could buy a basket of, if you're just buying treasuries, for example, you could buy a treasury ETF or buy a treasury outright and save some of that management fee. And my understanding is it's a lot more straightforward on that, because I could sell a 10-year bond and then buy a 10-year and 1 month bond. And those are different bonds, at least from the guidance I got at one point in time. But
if you're doing the same issuer, which is effectively like the U.S. government,
yes,
then changing your duration and your interest rate will, which if you change the duration, you'll almost always change the interest rate.
Yeah.
But changing those two things will effectively get you something that is not substantially similar. Yeah. If you have a different issuer, then there's some more discussion about that. Some people still believe you need to change both of those things. Candidly, for me, if you change your issuer on like a corporate bond, I'm pretty good.
Yeah. Yeah. Okay. The second item we've identified is Roth conversions. So this is number 2 of tax planning strategies in a down market, Roth conversions. Why are we looking at Roth conversions now in particular?
Why aren't we?
No, why are we?
Oh, why are we? Oh, well, because if your account is low and you convert it, it means you're able to convert more of your account, the greater percentage of your account, or more shares of something, or whatever it is, you can convert more. And hopefully, while this may not be the low, hopefully, well, certainly lower than it was at the start of the year in most cases. So you're able to convert more shares. If that recovery occurs, it occurs in the Roth IRA, where that growth is tax-free, at least if you follow the rules, as opposed to taxable if it occurs inside the traditional IRA at some point. So effectively, you're trying to have that recovery occur inside the Roth account, where you can enjoy all those gains tax-free down the road, as opposed to having that recovery occur in the pre-tax account, where if it happens one day, you'll have to pay the piper.
And mechanically, mechanics of this are, you can actually, let's say I have 5 holdings in my account, 3 of them are way down, 2 of them are up or down by just a little. My understanding, or at least my recollection, is I could actually convert positions in kind rather than having to liquidate and move the cash over. Is that still the way it works? Okay.
Yep, that is correct. You don't have to liquidate. You can keep the position in kind. Although, with trading costs, especially for equities today, with trading costs effectively like $0 in many cases. It's not as big of a deal if you sold it and then bought it right back in the other account, but you don't have to, right? It's just easier. You transfer the positions, you're done, you're never out of the market. And you just get taxed on the fair market value of the position when it was converted. So yeah, that works quite effectively in that situation.
The reporting can be a little difficult, right? Because sometimes you don't know the actual official dollar amount of the conversion until some later date.
Sure, it might be the end of the day if you're doing a mutual fund or something like that. And if you're trying to convert $34,259.68, you might need to leave yourself a little bit of room. But to that point, leave yourself a little bit of room, right? If you're running up against a tax bracket or a Medicare Part B bump or something like that, give yourself a little bit of space and breathing room there. You never know what's going to come up down the line. But yeah, I think that remains the same. The only thing that's different perhaps than what some advisors may remember from the last time, or I shouldn't say the last time, but from years ago, is that the Tax Cut and Jobs Act stopped the ability to recharacterize.
Yeah.
Right? So we used to be able to figure out which positions did well and which did not by converting to different accounts. Now we can't do that. Now, once it's converted, it's converted. So if you're, one defensive play here, if you will, is if you're thinking about converting $50,000 this year, maybe you convert 25,000 now and you wait and you see. This way, if the market continues to go back down, you get another $25,000 at the lower value. Now, of course, at some point, we do hope the market turns around and goes back up, in which case waiting to make that $25,000 conversion would cost money. So you've got to, have that internal discussion, or potentially external with the client as well. But look, if we certainly hope year to year that the market goes up. So even if you did a $25,000 conversion today down, and you did another $25,000 conversion later this year, or somehow the market got back to even, that would still be a win on average for the client,
long run,
right?
Yeah. All right, so Roth conversions we're doing in a down market for sure. The third strategy we've identified for tax planning in a down market would just be accelerating your retirement contributions, getting more into retirement now versus waiting till the end of the year or spreading it out entirely over the full year. What's our reasoning for doing that?
Now, this is largely based on how people actually go about making contributions, right? When you put money into an IRA or Roth IRA, it has to be a cash contribution. When money goes into a 401k or a Roth 401k or a similar plan, it's deferred from salary. So we're effectively taking what is cash and we're converting it into some sort of investment, right? Typically, once it's in the IRA, Roth IRA, 401k, it will be invested. And so this is nothing more than trying to buy low, right? Like, we don't know that today is the low. We know it is lower than it was at the start of the year. And so that's really the idea, right? Is if we can accelerate that, hopefully we're closer to the bottom than we are to the top, and we're making those investments closer to the bottom. If we sit here for a year and clients come back, in about 11 months from now and make their IRA contributions on tax day for next year, well, maybe the market's up 15%, and back to even or close to it. If you do, you're buying at a higher, at a higher price. Right. So just the same way, it's better to make contributions on average early in the year than it is later in the year, because on average things go up. Well, this is one of those times when we're bucking the averages. It's worth thinking about buying now while things have gone down. But again, no guarantee it goes up higher from here tomorrow, and that it doesn't go lower. But we know we're already at a better point than we were at the start of the year from a buyer's perspective.
From a buyer's perspective, yes.
From a buyer's.
From a holder's perspective, less so.
Yes.
Yep.
I'm trying to look at the silver lining here.
I love it. All right, Jeff. Well, there it is. That's 3 of our tax planning strategies for down markets. All of them relatively easy to implement. We don't need to go to the Cayman Islands or anything.
There's other things we could look at, for instance, like in executive comp world, do we exercise, certain options now, or do we, like all those sorts of things, what are we actually doing? When do we, but those are 3 bread and butter type of planning strategies that nearly every one of our working clients can think about doing, right? Capturing some of those tax losses on the taxable accounts, making those Roth conversions at depreciated values, and putting money into the retirement account and effectively buying in at lower values today than what we started the year at.
Perfect. I love it. Thank you, Jeff.
Thank you, sir.